from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, overshadowed Microsoft's slowing cloud growth has investors overlooking the strong second quarter report. We will break down the results. Plus, mission abort. Nvidia said to be preparing to abandon its $40 billion deal to acquire ARM. Now, ARM owner SoftBank is looking into an IPO. And buy now, pay later seems to be just about everywhere now. I will talk with one of the biggest companies behind this new approach to layaway. All that in a moment, but first let's get a look at the markets and straight to those tech results out after the bell. Here's our Ed Ludlow, obviously Microsoft, the one we're watching.
Yeah, the biggest name we're watching because it's the first mega cap to report this quarter. And if you look at the reaction in NASDAQ futures, my goodness, are they paying attention? Look, we're lower after the bell, down almost 5% in aftermarket. We've been even lower than that. 20% top line growth in the quarter, fiscal second quarter, $51 billion of sales, beat on the bottom line. And yet the market, as you say, they're focusing on Asia and cloud, which grew at a rate of a humble, Emily, guess what? 46% growth in cloud, and the market's disappointed. So clearly the bar was very high for a top line beat here, and worries about decelerating growth. We're going to hear about this all season long. Some positivity though, Texas Instruments. I love Texas Instruments. Really interesting, time to nerd out because it's the biggest maker, of course, of analog processors. It goes into all kinds of gadgetry. You see there that the stock's up more than 1.5% in after hours, partly because the outlook for the first quarter from Texas so good on a day that semiconductors were getting hammered. Let's look at the day. This was a risk-off day. Tech stocks under pressure. We did see dip buyers come in. We saw the NASDAQ 100 pair some losses, but then it gave up towards the end of the session, closing down 2.5%. Bitcoin has improved, though. If you look at the cryptocurrency space, Bitcoin came from a kind of low bar, 33,000 on Monday. We're trading around 36,700 per token right now. But the Bloomberg Galaxy Crypto Index, which has a number of constituents, broadly lower as the crypto space and some of those lower market value coins under pressure. And we talk about semiconductors. The SOX, the Philadelphia Semiconductor Index, closes up 1.3% Monday, down almost 4% Tuesday. A big reason, if you look at the points movers to the downside, Nvidia. Let me bring you this Bloomberg scoop, really important. According to sources, Nvidia is quietly preparing to give up on its acquisition of ARM, as you said. According to one source, they just privately don't think the deal can get done. They don't think it can get past regulators. This is a big story, and clearly it's had an impact on the industry and the market paying attention, Emily.
Absolutely. We're going to dig into Nvidia a bit more later this hour. I want to get back to Microsoft now, though. Thanks, Ed, and bring in Jeremy Goldman of Insider Intelligence. Jeremy, Microsoft shares still under pressure, down, still about 7.5% after hours. What's your big takeaway? What's going wrong here?
Well, I would actually say that there are a lot of strong fundamentals to look at for the future. And there's obviously a lot of market pressure that is, you can't really extricate from the larger market picture. Obviously, there is that slowing cloud growth, and that's something to pay attention to. I think another thing to pay attention to is that they've got, I believe, about 5 or so divisions that are growing at least 29% year over year, which I think a lot of companies would actually be pretty happy about.
So does the slowing cloud growth concern you to the extent that, we're emerging slowly, albeit out of this pandemic? And what does that mean for what's been a massive driver of their business over the next few years?
Yeah, I think that the slowing cloud growth, it's notable. It is definitely a call out. At the same time, Azure is making pretty significant inroads into AWS. So that's something that's also important to pay attention to. And then also, as Microsoft looks to the future, I would say that gaming and metaverse-related immersive technologies are going to be more and more important to their overall growth. So to me, it's not about necessarily what has happened, but what does that portend to the quarters ahead.
Now, let's talk about the deal everyone is talking about, the massive deal for Activision. Does that make you more excited about Microsoft's future? Are you at all concerned about the cultural issues? And obviously, this is such a behemoth, a big deal to take on as it is.
Yeah, I mean, obviously, I come from the bias of rather than being a financial analyst, we're covering marketing and immersive technologies and how brands can take advantage of them. So, given that, Microsoft seems poised to take more revenues out of the gaming space over the next few years. Obviously, the Activision Blizzard deal is a big part of that. But more importantly, they've shown that they have the ability to make major acquisitions in the gaming world and then figure out how to incorporate it into everything else that they're doing, right? It's important to note that, Satya Nadella, I think, even cited the metaverse as a major ambition for Microsoft well before Meta Platforms renamed itself. So I think based off of that, you can definitely see a lot of synergistic opportunities with the recent gaming planned acquisition.
Do you see this giving Microsoft a head start in the metaverse, perhaps even faster, farther than Meta has come so far, or Apple with its AR glasses that the company reportedly has been working on, but we haven't seen yet?
I mean, in short, yes. Part of the reason is that Microsoft is basically acquiring users right now, right? If you look at major games like Call of Duty, they're essentially the fundamental building blocks to building a metaverse, right? You can take these games and then you can start to do things that we wouldn't necessarily call gaming and start to do them within these gaming-like environments that are immersive. So obviously Microsoft doesn't have as much of an investment in the metaverse hardware as some companies like Meta do, but they still have quite a bit, and I think user acquisition is often the name of the game.
All right, Jeremy Goldman of Insider Intelligence. We're going to keep watching those Microsoft shares moving after hours. Thanks for your insight there. Now to an anniversary like no other. Just 1 year ago, the Wall Street Bets Reddit phenomenon basically kicked off that meme stock momentum that we are still seeing today, leading to Robinhood halting the buying of GameStop on its platform. The online brokerage then faced the fury of customers, lawmakers, and regulators to talk about the changes Robinhood has made 1 year on. Bloomberg's Annie Massa, who covers Robinhood, with us now. Annie, thank you so much for joining us. Put this into context. Gosh, it's crazy to remember where we were a year ago and what's happened since then. Talk to us about what this milestone really signifies.
Sure. So Robinhood has had a crazy past year. They already had risen to prominence during the pandemic when more retail traders were piling into the stock market and options markets and crypto trading. But that really reached another dimension during the GameStop episode that happened exactly a year ago. And that put Robinhood on the radar of many more people and also led to a huge influx of retail investors. Now, what's happened in the past year is Robinhood has IPO'd, and now it is a publicly traded company itself, but its own stock price has been tanking alongside this kind of slow grind of fewer retail investors being in the market. There is still elevated participation, but it's nowhere near what we were seeing about a year ago when GameStop was really reaching a fever pitch.
Robinhood just put out a blog post reflecting on what a year it has been. Robinhood was founded on a dream, they say, of helping more people invest for their futures. The retail investing revolution has shown us that a new generation of investors wants their voices to be heard. Our work has only just begun. Why do you think the stock price is falling? What has changed?
There are a couple of factors. I think you've seen investors have kind of come off of this idea that Robinhood is purely a financial technology company doing something extremely different from other publicly traded brokerages. Right now, I mean, its brokerage business in stock, options, crypto trading, that is something that's available at other brokerages as well. There was also this moment where it seemed like investors were only choosing Robinhood, or it was maybe the most prominent brokerage name for a while, and a bit of that luster may have worn off as well as investors dug in a little bit more. So it's certainly not necessarily going to dog them forever, but it's been a setback as public markets investors have taken a closer look at this company.
We did just cover Robinhood adding some new features to its platform, the ability for retail investors to ask questions of CEOs on earnings calls if they're upvoted via the Robinhood platform, thanks to their Say Technology acquisition Earnings are coming up. What are your expectations there? Could that lead to a change in the trajectory quickly?
So something to watch for in the earnings on Thursday is how retail investor participation has been going and how many people they have using their platforms. Broadly across the market, we've seen retail investor participation in U.S. stock trading fall off of those highs from last year. So that could be a setback for Robinhood if that trend continues.
All right, Bloomberg's Annie Massa will continue to watch your coverage. Thanks. Another story we're watching, President Biden will meet with more than half a dozen CEOs Wednesday who support Build Back Better, including a number of big Silicon Valley names. The White House is looking for a way to pass the president's economic agenda, which the administration says will strengthen the economy as well as workforce participation. We'll be monitoring that meeting tomorrow. Coming up, meantime, tensions between the U.S. and Russia keep rising.
We have no intention of putting American forces or NATO forces in Ukraine. But as I said, there are going to be serious economic consequences if he moves.
We'll have more on those sanctions, plus the cybersecurity warning the Biden administration just issued about Russia. That's next. This is Bloomberg.
I was here in 2014 when the United States first took actions when Russia invaded Crimea, and the options we're considering today are far more significant than the options we had taken then. All options are on the table. What we've done is that we've worked closely with our allies in Europe to make sure that we have a carefully designed set of sanctions that would have a significant impact on the Russian economy. We have a shared goal in terms of respecting the sovereignty of Ukraine and in terms of standing up and ensuring that we have sanctions at the ready in case a Russian troop enters Ukraine.
U.S. Deputy Treasury Secretary Wally Adeyemo outlining the Biden administration's plan of action to sanction Russia. The U.S. has put 8,500 troops on alert for possible deployment. This as Russia has as many as 100,000 troops on the border near eastern Ukraine. At the same time, the Department of Homeland Security is issuing a warning that Russia could levy cyber attacks against the U.S. in retaliation, warning that Russia could target critical infrastructure. For more on all this, I'm joined by General Keith Alexander, the former commander of U.S. Cyber Command, also the founder and co-CEO of IronNet. General Alexander, great to have your perspective on this. Obviously, cyber attacks from Russia, the threat of them, are nothing new. What makes this time different?
Well, I think right now, President Putin is looking at his options of how do I take over eastern Ukraine. It's clear that moving 100,000 troops on the border is a significant statement by him that he's serious about this. I think he's still weighing his options. And I think what the president, our president, and Europe is trying to do is how do we keep him from going into eastern Ukraine and doing what he did 8 years ago in Crimea. I think that's what he's trying to do. And I think he believes it's a good time to do it. There's a lot of opportunity here, and he's weighing the consequences, those increased sanctions, and Europe and the United States coming together to do that versus him getting eastern Ukraine, which he's always wanted. So this has gone on for a while. I think he's now putting a statement in. It's a good opportunity from his perspective. What's the cost?
What is the cost?
I think from my perspective, the cost would be they've got NATO and the US aligned and Europe aligned on this. I think we've got everybody leaning in. It was a great move, I think, by the administration in Europe to start bringing in more oil from the Middle East into Europe. I think that's a huge statement because that's a long time enduring economic impact on Russia. And it means that Europe can live without Russian oil and gas, and here's how we're going to do it. So I think that's key. What I worry about, though, is, as you mentioned this, is that the attacks on the Ukraine could just go in cyber like they did in 2017. And if you recall, those NotPetya attacks impacted the world. FedEx, Maersk. That destructive wiper virus caused a tremendous amount of problems for everyone. We could see the same thing here, and it could grow. And my concern is this could get out of hand. cyber is an element of national power. It's one element, and as soon as it escalates, we have a problem. That's what I would be most concerned about from my former time.
What about when it comes to a possible cyber attack on the United States? What would you be most concerned about there? Is it an attack on critical infrastructure? Is it an attack on, hospital records, the power grid, the supply chain?
Each one of those has different consequences from my perspective. If you think about what are they going to hit, there are devastating attacks that they could do against the energy, the oil and gas sector. Think Colonial Pipeline and a number of those. Actions they could do against hospitals. But if they do that against hospitals, that has a different, I think, set with our people. Going after energy and shutting down the pipelines, the oil and gas, what would that do to our will to engage? That's the question. What Russia is going to look at, what can they do to impact the will of the American people? And what can they do to impact the will of the European people in this conflict? That will to fight, that will to push back is something that we have to consider. It could backfire. They could think we're going to do this and it would backfire as it did in World War II. So I think these are the things that we have to consider. As you look at this, Emily, what it all comes back to is what Chris Inglis talked about a few weeks ago and what they did in the Solarium Commission. We have to now think about cyber as an element of national power, how we're going to bring the public and private sector together to defend this nation and to work with our allies. We got to get that going.
What kind of cyber actions on the United States or Ukraine would lead the U.S. to retaliate? And what kind of offensive cyber actions do you imagine the U.S. would take?
Well, I think there's both covert and overt operations and things that we would do. I'm sure they would consider all of those. And really what the National Security Council would do is bring all that together. They'd bring in General Nakasone and the team and say, what options do we have? What can we do to respond? What would we do diplomatically? What would we do economically? What can we do in cyber? And what other actions can we and our allies take? All of that comes up with a series of capabilities that the president and the Principals Committee would look at. In taking all that together, from my perspective, you've hit some of the key things. Critical infrastructure, what do they do? If you hit critical infrastructure and it causes significant damage to this country, I believe it will not go without a response. And what that response would be is where the president has a choice and the Secretary of Defense. They can get together and say, what are we going to do? And each of those, the calculation has to go, we don't want another war, but we can't let people like President Putin just take over countries like they did Crimea. And we are going to see multiple sites of this, Emily, and we're seeing it in the Middle East and you're seeing it in Asia. And this is a really tough time. And I believe it's going to get worse.
All right. We'll keep watching. Thank you for that warning, General Keith Alexander of IronNet Cybersecurity. Thank you, as always, for stopping by. Coming up, Netflix betting big on the Asia-Pacific region on the heels of a brutal sell-off. Our conversation with the company's Vice President of Contact for APAC next. This is Bloomberg. The pressure on Netflix not easing up after its massive sell-off. The streaming giant now looking to the Asia-Pacific region to help drive new growth. Bloomberg spoke to Min Young Kim, Vice President of Content for APAC, and asked if she's concerned about declining subscriber growth. Take a listen.
Not really. I think what really drives our growth is the strong slate. And if I think about the slate that's upcoming in Asia in 2022, my team, and all of our Netflix employees, along with the fans of content made in Asia, are very excited of what's coming. In COVID, we've had a couple of headwinds in terms of the production. There were a little bit of production delays, and Omicron has unfortunately sort of set back us a little bit. But we're very confident that we will be able to bring another set of a strong slate in 2022. And if you look at 2021, APAC was at the forefront of really driving the growth for our service. And I do believe that it will continue in 2022.
Yeah, let's talk a little more about that slate, because Korean language productions were the real breakout hit of 2021, and you've recently announced the latest Korean content lineup. So how does this reflect your strategy for dealing with demand around Korean content?
Well, so last week was an exciting, we had an exciting announcement that really sort of pleased a lot of members on Netflix and outside of Netflix who really enjoy Korean content. We've announced about 25 shows, a very wide variety of different genre and format. And I mean, last year, I think we all know that the world has actually responded in huge numbers on their love for Korean content. I think Squid Game really helped us drive that love and excitement. But you know, so that's on that 25 slate. We have shows like All of Us Are Dead, and we also have shows like Money Heist Korea, which is an adaptation of our popular Spanish series. We're also very excited to present our first set of our original film production, and also our unscripted programming, followed by the recent success of Singles Infernal. But what I want to emphasize is when it comes to local content, what we're really aiming for is local impact. We want to make sure that we program our service around Korean content to please our Korean members and our members in Asia. And I think it's just exciting that with the increased demand on Korean content, the world is just enjoying what we're watching together.
Min-Young Kim there, Netflix Vice President of Content for APAC with Bloomberg Sherry-On and Paul Allen. Coming up, a new trend continues to gain steam as more shoppers choose buy now, pay later. Our exclusive interview with Klarna CEO and co-founder Sebastian Chimikovsky, one of the industry's biggest players, ahead. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Bloomberg has learned that Nvidia is preparing to abandon its purchase of ARM from SoftBank. The company has made little to no progress in winning approval for the $40 billion chip deal. Meantime, SoftBank is stepping up preparations for an ARM IPO as an alternative. Our Ian King, who covers chips, joins us now. Ian, is the ARM deal dead at this point?
Yeah, I mean, what our reporting showed is that there are significant groups within both companies that really just are bowing to what they believe is the inevitability of this not making it through the regulatory process, and that it's just not going to happen. And publicly, of course, though, we need to point out that the companies are both saying, look, it still is going to happen, and are sticking with working their way through that process still.
So what's next for ARM if Nvidia can't buy it?
Yeah, no, that's a very good question. All along, SoftBank has said, look, an IPO is our kind of our plan B. It's what they were going to do before Nvidia came along and asked them the money, and offered all of the money. But the big question there is sort of where and when and how much can SoftBank raise in the process of an IPO, depending upon where chip valuations are. And the bottom line is that it's probably going to be difficult for them to get the same kind of return that they would get if they were going to be paid in Nvidia stock.
Now, it's no secret that Nvidia's competitors didn't necessarily want this deal to happen. Take a listen to what Qualcomm CEO Cristiano Amon told us a few months ago.
ARM already won. And they won because they're independent. It's not like you need one company to buy ARM, to invest in ARM for them to win.
He's saying there he wants ARM to stay independent. Basically, what does this mean for Nvidia's competitors? Is this good news for them?
Yeah, I mean, you've just had a CEO of a company publicly talking about M&A between, competitors and suppliers. I mean, it doesn't get more direct than that. And in our story today, we mentioned a whole host of other large companies that really don't like this deal as well. So, yes, you could say it is a victory for them. Nvidia would counter and say, look, we were going to give ARM a ton of money and we were going to keep it independent. So who's the loser there? But obviously, they don't buy that argument. They don't buy the argument that Nvidia could invest in ARM, own it, and keep it independent.
Today, the Biden administration said, meantime, the chip shortage is going to continue at least through the end of this year. What's the outlook on how to turn this around and how the government can and will help?
Yeah, no, that's the key question, Emily, you've asked there. We've known that this report was coming for a while, and what they've really done is come along and say, oh, hey, we're going to do something about this, and then they've gone through the reporting process and come up with the answer, which is, yeah, it's pretty much what the industry said it was, which is pretty bad for some areas of the economy, and we kind of have to leave this to the private sector to sort this out. So not a great conclusion for the automakers and various other, key components of the economy that really are suffering because of the shortage of semiconductors.
All right, Ian King, who covers chips for us, as always, thanks for your reporting. Meantime, a host of new players in consumer finance have retailers getting excited and regulators asking questions. The so-called buy now, pay later space lets shoppers take home purchases immediately while effectively taking out short-term loans. In the U.S., use of services like Klarna and Afterpay has jumped 300% every year since 2018. Joining us now, Sebastian Siemiankowski, Klarna CEO and co-founder. Sebastian, great to have you back with us. So look, regulators are asking questions. What does that mean for growth that you see ahead this year? Is it still going to jump that 300%?
Yes, very much so, I believe, actually. I think it's a good thing they're asking questions. We've seen similar things in Europe previously. But I mean, I think one thing to put in perspective here, in 2019, Americans paid $14 billion in late fees to credit card companies. They paid $120 billion per year in credit card interest and fees. And the buy now, pay later services are interest-free and free of charges for consumers. So with that in perspective, it just tells you how much growth opportunity there is to disrupt that industry, try to provide a better service for consumers.
Well, the CFPB launched an investigation into the industry last month, and I'm curious what your interactions with the agency have been so far. Do you get the sense they want to see the industry grow, or they want to take a pause?
Well, I think that as any regulators, when something new comes wrong, right? They want to try to understand it. Is this actually something good or bad? And what's the implications for consumers? Are they following best practice standards? And what's the implications? And so I would maybe at this point in time call it more a query than an investigation. But with that said, I think it's healthy. I think they should be asking questions, and there may be aspects of products that where regulation should be improved. It could be changed. We've seen that in the UK as an example, where there's a suggestion for improved legislation that Klarna supports. But again, if you look at the data, which most regulators eventually tend to start doing, we see our credit card, our losses are 30-40% below industry standards of credit cards. So these type of credits are better for consumers because there's an underwriting decision per every transaction, which is very different from how credit card works, where you just get a huge limit and then go out and spend it, and the bank doesn't really care. They just want you to maximize your debt.
But let's talk about what's better for retailers, because as I understand it, most buy now, pay later options ask the merchant to pay 6% of whatever a customer is buying. Merchants aren't happy about paying 2% to the credit card company. So how are you convincing them to pay that 6%?
Yeah, I wish I could convince them to pay 6%, but it was a long time ago I heard any deal that we're in being quoted at those levels. I think that The price has dropped due to competition. I think those were levels that were, slightly crazy maybe at the beginning, but today we're seeing more competitive rates. And to us, it's actually, if you look at Klarna, we compete in a market in Europe which is regulated in regards to interchange both on debit and credit, and have been able to reach such scale with almost 100 million users now that we can very effectively compete with credit cards from a cost perspective as well. And we have the ambition to reach that economies of scales in the US with reaching now almost 25 million users. So I think over time, we believe that we can become really competitive when we are both pushing costs of payments down and providing better services for consumers and merchants. So, but obviously, initially when you enter a market, you may not necessarily be able to price there just yet. So I think we're going to see those costs come closer to each other over time.
Interesting. Well, every time you're on, I got to ask you how your thoughts are evolving on crypto. We are currently feeling the chill of a crypto winter. Not sure how long it's going to last. How are you thinking about this and the future of Klarna plus crypto? Right.
Well, we obviously one of few players of our size that have kind of kept away. And as I've said previously, I think about it in two ways. I think about it as an asset and as a technology. As a technology, we've been trying to apply it to somehow make our services work better, become more efficient, or at lower cost. Have just not been able to apply the technology in such a way that it's helped anything. As an asset, look, people put money in all tons of different assets. Some people put it in nice old paintings, and some people in gold, and some people in something else. Like preferably, I really like paintings, more than crypto, but that's obviously a matter of taste. But I'm very worried how it seems to be the case that none of the regulation we have in regards to how to, market assets or equity instruments and so forth that apply to stock. If I would go out and do the kind of advertising for Klarna stock that's being done for crypto, I would most likely end up in jail. And so that is very, very worrying to me, because I do worry there might be some crypto holders that have borrowed money, that have used credit to buy more, and if prices continue to drop, we may see some very negative consequences and some very sad outcomes as a consequence of that. So I sincerely hope that we will at least will see some more sanity around how these products are being advertised, and that they follow the same standards that any other financial investment categories have on them.
Interesting. All right. Well, I'm glad I'm asked you for an update. Thanks again for joining us, Sebastian Chimiankovsky, Klarna CEO and co-founder. Appreciate you stopping by. Coming up, 2021. It was a record year for VC funding. Money poured in. But will 2022 bring the same, or will we see a cooling off there as well? My interview next with Hemant Taneja of General Catalyst. Up next, this is Bloomberg. We all know 2021 was a record year for VC fundraising and investing, but as we continue to watch the markets whiplash, some investors are wondering if there's a disconnect between valuations and if a funding correction could be coming. While that could take months or years, my next guest is issuing his own warning to VCs and founders about the need to invest in companies that are more sustainable and get away from the ones that move fast and break things. Remember Facebook's old tagline? Joining me now, Hemant Taneja. He is the managing partner at General Catalyst, out with a new book, Intended Consequences: How to Build Market-Leading Companies with Responsible Innovation. So what counts, Hemant, as responsible innovation? Are you talking about profits or mission or building a diverse team?
Emily, responsible innovation is a mindset and mechanisms to build companies that simultaneously optimize financial and societal return. I think if you think about technology, we don't build software for different stakeholders in the economy anymore. We actually build very important businesses, sometimes building healthcare businesses or banks or insurance companies. The responsibility around those is so much greater than what tech used to do, that we do need a playbook around how to build these companies in a way that they're fundamentally in the interest of society.
Well, VCs also have a role to play, and you actually call out Reid Hoffman, the co-founder of LinkedIn, partner at Greylock, for his method of blitz scaling. What do you think is wrong with that?
Well, look, first of all, Reid's a great fan. And, blitzscaling represents a playbook for growth. How we build companies that can scale fast once they've gotten product market fit. And there's actually nothing wrong with that, except that when you're moving really fast, there can be unintended consequences. And so what we are advocating in this book is to also have a playbook for responsible innovation, mindset and mechanisms, the business model choices, product choices, governance that allows you to make sure these companies are not moving fast and breaking things and are actually building for all stakeholders in society.
Speaking of Meta, of course, formerly known as Facebook, I recently spoke with Andrew Bosworth, who's, of course, running their AR efforts, now the CTO. Here's what he had to say about responsible innovation there.
I think we can do a lot better job than we have historically because we have a historical record of the types of abuses that have happened in digitally connected spaces.
Should we believe Facebook or now Meta? Are they a responsible innovator?
Look, any company has the opportunity to learn from its past and make intentional choices going to the future. I think we're hopeful that even at Meta, you've got lots of great people that are thinking about those choices as well. The key is going to be to think through what's best for all the stakeholders, and let's see how they do.
Now, we're seeing obviously a big public tech equity sell-off. Is this leaving you at all concerned about a pullback in the private markets? I know you work at earlier stages. We hear from VCs all the time. They're not paying attention to what's happening in the public markets. But I wonder if all this money flowing in, all these high valuations that we're seeing, if there's a correction coming.
Yeah, look, most people don't understand the impact of interest rates on valuations. A % increase in interest rates typically leads to 15 to 20% reduction in valuations when you do discounted cash flow models. So I think some of this is actually not a surprise. I think markets anticipating the interest rate rise. And honestly, the world of near zero Fed rates and also 7% inflation didn't make sense anyways. So this is actually healthy. I'm actually hoping that this mindset and this correction can start to impact how we're also building companies and funding them and scaling them in the private markets as well. Because there's phenomenal opportunities. There's a lot of capital that's been raised, but at the end of the day, we're not going to build great companies if we overcapitalize and don't build responsibly. So I think it hopefully will slow us down, make us more intentional, and build better companies.
All right, well, we'll be watching to see if that indeed happens. Hemant Taneja, General Catalyst Managing Partner, thank you for stopping by. Coming up, a stock rebound attempt fails as investors remain on edge over the Fed and those rates we were just talking about. We're going to take a look at how the tech sector is playing a role next. This is Bloomberg.
Apple's first product launch event of 2022 is fast approaching, and it's likely to be all about a new iPhone and a new iPad. The company is planning to hold its first event of the year this spring in either March or April. So, what's on tap? A new iPhone SE with a faster processor, and for the first time in that model, 5G. The new device is likely to take a similar shape to the SE from 2020, and it will offer Apple users a low-cost 5G alternative to the iPhone 12 and the iPhone 13. A new iPad's also likely, with the company planning for this year a new iPad Air with 5G and a faster chip to replace the current Air launched late in 2020. The new products will start a giant rollout of new devices for Apple in 2022, which is slated to include 4 revamped iPhone 14 models, 3 new Apple Watch variations, a revamped MacBook Air with a new chip, a new Mac Pro desktop, a larger Pro iMac, updated AirPods earbuds, a new low-cost iPad, and even an all-new iPad Pro with MagSafe wireless charging. The SC and the Air aren't Apple's breadwinners, but they do represent key products that retain users in the larger Apple ecosystem and can even possibly pull in switchers from Android and other rival platforms. For those awaiting the iPhone 14, expect a new design with a smaller camera cutout on the front, a much faster processor, and far better cameras. I'm Mark Gurman. This is Power On.
And don't forget, you can subscribe to Mark's weekly Power On newsletter at Bloomberg.com. I want to get back to the markets, take stock as we dive into a busy earnings seasons for the world's biggest companies to watch. We've already gotten Microsoft and IBM numbers. Next up, Intel and Tesla Wednesday, Apple coming up Thursday, and next week, Facebook parent Meta and Google parent Alphabet, plus a whole lot more. Our Ed Ludlow here to break it all down. Ed, still following those Microsoft numbers and still looking at not great investor reaction.
Yeah, the bulls had really pinned a lot of hope on this week. And next week, you know, going into this week in particular, so much volatility around tech stocks, the focus being the Fed and the outlook for rates. Then you come back from the weekend, there's a lot of nervousness about geopolitical risk, tensions between the Ukraine and Russia. And if you read the Wall Street notes, everyone was really hoping for not just top line beats, but bottom line beats as well. Because before Monday, 7 of the S&P 500 companies that reported had done really well from an earnings beat perspective. Then we got Microsoft. And if you look at the aftermarket reaction, not just Microsoft itself, but NASDAQ 100 futures, ETFs that track the NASDAQ 100, they're both down. And gosh, does it set a pretty grumpy tone for the rest of this week.
Talk to us about what's driving today specifically. Obviously, we got Nvidia, not good for the rest of the semiconductors.
Yeah, this was a big scoop from Bloomberg, and you just look at where Nvidia sits within the spectrum of the big points movers on the NASDAQ 100. I think I'm right in saying it was the second biggest points laggard. You know, it has outsized influence. It's grown so enormously over the course of the pandemic in terms of the gains in its share price. So when we have news like this, it does move the index lower, and it's kind of, again, it's another risk factor, right? It's uncertainty. It's investors saying, uh-oh, this is something else we have to worry about in this industry. And as you know, Emily, because I asked you about it yesterday, the index has had its worst start since 1994. You've got to go back a long way for semiconductors to do so poorly.
So talk to us about what's on tap this week with Tesla, especially, obviously a company that you follow closely.
Yeah, it's really interesting. We've been talking as a newsroom, well, what do we treat Tesla as, right? Do you remember, in the last 18 months where we were sort of getting really obsessed about Tesla being profitable? And then Tesla joined the S&P 500. It did that. 6 consecutive quarters of profit added to the S&P 500. It's really ramped up its production of vehicles to just numbers that we didn't think it would be able to achieve in the context of the semiconductor shortage, in global supply chain crunches. So what do we look to? Well, just really boring stuff. Financials. How's its margin doing? Its automotive margin and gross margin. How much money is it making from regulatory credits? And we know that Elon Musk is going to appear at this earnings call because remember, he said he's not interested in them anymore. So what's he going to say? What's he got up his sleeve?
All right. Well, we'll be watching. We'll be having you helping us break it all down. Ed, thank you. Well, the days of number 2 pencils and filling in bubbles are going away for high school students. The College Board says the SAT is going digital. It'll make the change internationally next year and in 2024 in the US. The goal to make the test more relevant as more colleges make it optional for admissions. And that does it for this edition of Bloomberg Technology. Tune in tomorrow. We've got more on the buy now, pay later landscape. Plus, we'll be speaking exclusively with Affirm CEO Max Levchin, of course, a competitor of Klarna. We're also going to be joined by Kevin Mayer, co-CEO of Candle, and, of course, former head of Disney Streaming and former CEO of TikTok. You don't want to miss it. This is Bloomberg.